Welcome back. Strathcona Resources, of course, has announced its intention to make a $4 billion offer for MEG Energy. That's $4 billion US. It would be 6 billion Canadian. A deal, our next guest says, is in order to make the deal successful, Strathcona must raise the bid by at least 25%. Let's get more on that with Julian Klymochko. He's CEO and Chief Investment Officer at Accelerate. Julian, thanks a lot. You, like others, I'm guessing, think this offer is a bit on the modest side from Strathcona, correct?
Well, that's correct, Paul. It can be viewed as a pretty skinny premium on the good side, and others just view it as a non-starter because it's so low. It comes at a 9.3% premium. If we look at historical precedents, typically hostile takeovers get done with premiums more than fivefold higher, so more than 50% greater than the unaffected price. So I get the sense that the bid ask between what Strathcona is out offering with its initial unsolicited proposal and what MEG shareholders are asking, it's pretty wide there. But as we know, in this type of situation, you never put your best offer first. So we'll look for Strathcona to increase that offer over time. But at this point, MEG shareholders are expecting a lot more. If we look at how MEG is trading right now, their shares are roughly 10% above the current value of the consideration, which is $4.10 in cash and 0.62 shares, worth about $22.80. So shareholders expect more. The bidder never really starts with their best and final. And it's just the first chapter in the story, so look for more action there.
The performance of MEG Energy shares over the past year has been brutal. MEG Energy shareholders would be happy to get a premium. They would like a larger premium, no doubt. But there would also be little doubt, you would think, that most MEG Energy shareholders would be happy to be taken out at a higher share price. We're looking at the stock graph right now. A year ago, this was a roughly $31 stock. It's now a $25 stock.
Yeah, it's a really good point. And if we look at MEG's story, it's somewhat complicated because it's regarded as very good assets that they have, but perhaps not optimized in terms of shareholder value. And within MEG's complex history is they actually had a hostile takeover bid from Husky back in 2018, which surprisingly was at $6.4 billion compared to the current $6.2 billion. Now, since then, over the past 7 years, MEG has paid down a significant amount of debt. And with that, the shares have gone from $8 to now north of 22. But if we go back to 2018, that takeover bid from Husky was $11 per share compared to an $8 unaffected price, which made for a 37% premium, significantly higher than the current 9.3% premium offered by Strathcona. And even with that 37% premium, that was rejected by MEG's board of directors. And 4 months later, Husky abandoned the offer and blamed it on market conditions. So who knows what'll happen here, but I think there's more to come.
What do you think of the sector at large, Julian?
Well, the Canadian oil patch is an interesting sector. It's really been in a long-term bear market. It basically peaked in 2014 and hasn't been the same ever since. And typically it's a pretty tight-knit community in Calgary, and you rarely see hostile takeovers. In fact, the last one of significance was Suncor's hostile takeover of Canadian oil sands back in 2015. So we're talking about 10 years ago in terms of significant hostile takeovers. So the sector has been through quite the rough ride. Granted, it's on a bit of a recovery over the past few years, so it really depends on the direction of the price of oil, which hasn't been in its favor lately.
Do you own shares of oil and gas producers on behalf of clients?
We do have long and short positions in various oil and gas producers, so as long as you pick your spots, you can do well.
So you're short on some of the names. That's interesting.
Yes, correct.
Okay, Julian, thanks a lot for joining us. Julian Klymochko, CEO and Chief Investment Officer at Accelerate.